Hi, I'm Kylie Matu and welcome to Wealthy Millionaire. Today we're going to talk about how much mortgage you can afford. But first, I'm not a licensed broker, I'm not a real estate agent or a lawyer, so please always make sure to contact a professional. Buying a house for the first time will be the biggest investment purchase that you'll make. So you want to take into account all the factors, especially when you have to consider how much house you can afford. There are some special guidelines that you can follow and factors to consider that will help you navigate this process and remain within your budget. How much house can you afford with $76,000? And how much house can you afford making $63,000 a year? No matter what numbers you're working with, you can estimate how much house you can afford by looking at the following aspects of your finances. The first place you want to start is to calculate your revenue streams. This is how much income you're bringing in each month. You can start with a primary salary, but you're also going to include all of your monthly income in this calculation. This includes part-time earnings, investment earnings, Social Security payments, and any other regular income stream. If you're buying with a partner, include their monthly income as well. For this, you'll be using your gross monthly income. This is income that has been earned before any taxes. Next, we have financial obligations and debts. While your income will be an important factor in determining how much house you can afford, lenders will look at your income relative to the amount of debt that you maintain. Debt refers to regular payments that you have to make towards a loan, such as car payments, student loans, and other types of loans. Having debt actually isn't necessarily a bad thing. In fact, in many scenarios, it has a positive impact on your credit score. It's simply a component of your finance that lenders will consider when going through the mortgage approval process. Generally speaking, banks and lenders will take into account the financial obligations that you will have for at least the next 10 months. Then we have your debt to income ratio. The debt to income, which we call a DTI, it shows how much of your monthly income is going to go towards paying off your debts. It's a calculation used by lenders to determine how much of your monthly income is already committed to existing or even upcoming financial obligations. When you go through a mortgage application process, lenders look for a low DTI. This tells them that you have enough money to make your payments on time each month. The equation for calculating the debt to income ratio is DTI, which equals your monthly debts to gross monthly income. So some of the debts that may be considered in the calculation are credit card payments, student loans, personal loans, car loans, other mortgages, child support, or alimony payments. As you can see, the considerations for debt calculation when it comes to finding your DTI involve recurring payments. So mostly towards the lines of credits and loans. Generally speaking, you won't have to include monthly bills for utilities, food, or other regular living expenses. So calculating your DTI. Once you've found your monthly income and your monthly debt, you can plug those numbers in the DTI formula to find your DTI. When you divide your monthly debt by your monthly gross, you'll get a decimal number. We want to multiply that number by 100 to receive the percentage that is your DTI. Banks and lenders will use the calculation of your DTI as a basis for approving you for a mortgage and determining how much that mortgage is going to be. Ultimately, an applicant's DTI, credit score, credit report, down payment, and loan amount will affect the approval of the mortgage. In addition, the location that you are applying for in can affect the standards for the mortgage. If you're applying for a conventional loan, there are some guidelines that you can follow. Conventional loans are typically made by a private mortgage provider such as a bank or a credit union. And these loans are typically secured for mortgages on residential properties. Some home loans considered conventional mortgages generally abide by the following guidelines. A minimum credit score of 640. So this can vary depending on other factors, as well as a DTI, 43% or less. No prior bankruptcies or foreclosures. A down payment, which is 3% to about 20%. And all of these considerations go into a lender deciding how big of a mortgage you can afford. Ultimately, you will need to work with a lender to figure out exactly how much house it is that you can afford, given your current financial situation. That being said, you can do some preliminary calculations to get a better sense of your budget. Create a mortgage affordability template using these categories to crunch the numbers on what you can afford. First, we have your down payment. How much money do you have for a down payment? You should know how much liquid cash you have to put towards your down payment as well. You may need to pay as much as 20% of the home price as a down payment. In fact, putting down 20% can save you money as you won't be obligated to pay mortgage insurance premiums. Once you know how much you can or are willing to commit to for a down payment, you can then figure out the price range of the home that you're looking for. So for instance, if you have $60,000 towards a down payment, you know that you can look at homes that are approximately $300,000. $60,000 is 20% down payment on a $300,000 home. This is a conservative estimate, given that it assumes putting down a 20% down payment, which you may not have to do. However, if you end up putting down a lower percentage for a down payment, that will only increase your spending power when it comes to the price of your home. Next, we have your interest rate. So this is a percentage of your mortgage for the cost of borrowing the principal amount of your loan. So example, $300,000. Most mortgage loan interest rates are fixed, meaning that the percentage will remain the same over the life of the loan unless you refinance. Look up current mortgage rates to estimate what your interest rate may be. Better credit scores will also lower your interest rates. So if you have already been quoted an interest rate from a bank, use that in your calculations. Lastly, in order to calculate how much house you can afford, you will need to consider the loan term of your mortgage. So most mortgages are paid off over a 10, 15, 20, or a 30-year period. And when you pay over 30 years, your monthly payments will be lower than if you were to pay off your mortgage in 10 years. However, you will end up paying more interest over the longer loan terms. There are other loan types that you may be able to utilize to finance the purchase of a property. This includes government-backed loans like FHA loans and VA loans. If you have a military connection or have served in the military, you may be eligible for a VA loan that is backed by the Department of Veterans Affairs. Usually these types of loans don't require a down payment. VA loans are available to qualified U.S. veterans and active duty military. Some surviving spouses are also eligible for this type of loan. To calculate how much house you can afford with a VA loan, you'll want to make sure you are eligible. Then find out what the current loan limit is for the VA loans in your area. You'll need to purchase a house within that limit in order to not have to pay a down payment for your home. An FHA loan is insured by the Federal Housing Authority. It's a great mortgage for first-time homebuyers as it requires a lower down payment compared to conventional loans. And because the loan is backed by the federal government, lenders will approve borrowers with lower credit scores. Additionally, these loan types have more flexibility when it comes to putting down a down payment, where you could put down as low as 3.5%. Generally, an FHA debt-to-income ratio of 55% and lower is required. When deciding on how much of your income should go towards your mortgage, we like to use the 28-36 rule. So what is this rule? The 28-36 rule is a percentage calculation used to calculate the amount of debt that an individual or household can handle or should assume. If we look at the 28-36 rule, an individual or household should only spend a maximum of 28% of its gross monthly income on housing expenses and no more than 36% on total debt. This rule is used when determining whether a lender will extend credit to borrowers. Just keep in mind that not all lenders use exact percentages, as some may lower the requirements and others may raise the required percentages. Other factors to consider when determining the affordability of a house is things like home maintenance and emergencies. Just like a car, a home requires maintenance and can pop up at inconvenient times throughout the year. You'll want to make sure to set aside money for such emergencies. It's recommended to save 1 to 4% of your home's value for repairs each year if possible. Household income changes. Things may change due to internal or external circumstances, which may affect your total monthly income. Whether it's a career change or employment situation changes, make sure to factor that into your budget. You don't want to commit to a mortgage that you can no longer afford. Insurers may also offer you a larger mortgage. Though it may be enticing, be careful not to commit to a mortgage that you're not comfortable with or did not originally budget for. Buying a house can be an intimidating process starting out, especially when you have to consider how much house you can afford. I hope these guidelines and factors can help you to navigate through the process and remain within your budget. I'm Kylie Matu. Thank you for watching Wealthy Millionaire.